So examples of temporary differences. So revenues and gains, tax for income tax purposes before recognized in financial income. Expenses and losses, these are going to be recognized in financial income, later deducted for income tax purposes. We'll see lots of these examples, right? Pretty much the main temporary difference we're going to see is depreciation. All right, well, what are we going to deal with here? So the transaction, right? If it's a revenue or a gain, if it's recorded in the books earlier, once it recorded on the tax return later, it's going to result in a liability. What does that mean? So if we record more revenue earlier on from the books in GAAP, that's going to be a liability, right? Because we are not paying that on the tax return. Now, this is something to really wrap your mind around, and it might be, a lot to gather. So let's say, we've got some temporary difference, and for the book purposes for GAAP, for financial statements, we recognize 100,000, and then for the tax return, we only recognize 50,000. So we have 50,000 more to recognize later for the tax return, meaning we're going to pay, let's say, a 35% tax rate on the 100,000 for the books, 35% tax rate for 50,000 on the tax return. We've got an extra 50,000 to pay up later per the books. That's going to be a liability. Because this is what is really happening, right? This is the really tax you're going with. Similarly, if we flip it around, the revenue and gain, well, let's say I record $50,000 gain. This is temporary, right? Temporary difference reconciling, and this is going to come from cash versus accrual revenue. Well, for the tax return, if we're recognizing $100,000 in the tax return and only 50 on the books, that means that's more income for the tax return. You're getting taxed on that all right now, and you're paying more tax per the tax return than you are for the books. So that's a deferred tax asset because you've essentially prepaid. You paid earlier than you would have paid otherwise. Similar for expense or loss. So for depreciation expense, let's start with this. Let's go back to the other way around. Let's say for the book purposes, I can deduct $100,000. And for the tax return, I can only deduct $50,000. Well, here, okay, that means my overall net income is lower for the books, and then I have higher taxable income, and from that point, right, then I'm gonna have to pay more tax on the tax return as compared to the books, and that would give me an asset because I've essentially quote unquote overpaid per the tax return. And you can tell I have to sit here and think about it. You can go through it a million times, you can memorize it, you can really think about it. It's tricky, it's difficult. Think about it. Take a pause and think about it. You're never going to get this and just snap your fingers and go, okay, boom, I can get this right off the top of my, tip of my tongue and flawlessly, answer these questions. This is something where you're going to sit back and think about it. And if you are getting it, absolutely right off the bat and just having no issues, props to you. Contact me. Let's talk. I'd love to, see how your mind works. That is, something that would be awesome to see. Other way around, right? So if you record for the books later, meaning let's say we only do 50,000 of depreciation expense for the books, but we do 100 for the tax return, well, that means our net income that we're getting taxed on the tax return is going to be lower. It's going to be higher for book, going to be a deferred tax liability. So just play with the numbers. Play with the numbers and think about it. That's another great tip I have for you is create your own numbers and think about it, right? Like if you have the same amount of income for both, but for expenses, you've got higher on one, is that going to, did you pay more for the tax or the book, right? Think about that. Is that going to result in an asset or a liability?